So one of the most important criteria I look at investing in a company is that the company must have a sustainable competitive advantage that protects it from potential competition. And we call this an economic moat. So when a company has got a moat, like a protection around it, it's able to keep raising prices to pass on inflation to consumers. It's able to maintain their profit margins. That's why a moat is very important. But if a company doesn't have a strong moat, competitors can come in and take away market share, forcing them to cut prices, and in the future that lowers their profit margins. And that, of course, lowers the share price in the long run. So there are three kinds of moats. You can have companies with a wide moat. Wide moat basically means there's no competition. It's the only guy in the room. For example, Alphabet that owns Google and YouTube, that's a wide moat company. I mean, think about Google, there's no competition, okay? But a company like Tesla is not a wide moat company, it's a narrow moat company because there are significant competitors that can potentially take away its market share. Especially, for example, in China, you've got NIO, you've got BYD, you've got Toyota coming up, you've got GM, you've got Ford coming up with electric vehicles. So the moat is a narrow moat. It's not a wide moat, it's a narrow moat, which is still investable, but it's a bit more risky. All right. So what are the sources of Tesla's moat? There are two sources of its moat. The first source is Tesla's brand equity. What makes Tesla Tesla is it's got a very strong brand monopoly currently in the US electric vehicle industry. Currently, it's got 65% market share of all electric vehicles in the US. So that is a brand monopoly. Of course, it's come down a bit. It used to be over 70%, but it's still 65%. So again, having this brand monopoly gives it its pricing power. It's able to price higher than other electric vehicle companies, giving them great profit margins. A lot of Tesla's brand equity also comes from the reputation of its founder Elon Musk, who's like a larger than life character, right? Known again as the real life Tony Stark. And that has generated a lot of free publicity for Tesla, making it a really cool vehicle to own. But again, that could be a double-edged sword and that could backfire if Elon gets hit by a truck or he goes a bit nuts, which some people are saying is happening right now. Up for interpretation, right? The other part about Tesla's brand equity is its proprietary technology patents. It owns some of the best patents in the autonomous driving technology as well as its electric vehicle technology. So for example, it's way ahead of the competition in terms of miles per kilowatt hour. But again, can this be replicated eventually? Can competitors catch up? Maybe, right? The other thing would be, of course, its superior customer service. The fact that you don't have to go down and service your car. They pick it up from you, they service it, they send it back to you, and you can download all the latest software on Wi-Fi or cellular. So it makes it really, really cool. The second source of Tesla's moat and competitive advantage is its manufacturing scale. So it's got the biggest scale in electric vehicle manufacturing right now in the US, okay? So that gives it a cost advantage. It can produce an EV cheaper than any other competitor. So for example, in the last 4 years, their average cost of making a vehicle has fallen 55%, and hence their gross margins have expanded from 23% to 30%. And they also plan to further reduce their battery cell cost by 56% over the next several years. So again, over the years, it becomes cheaper for them to make each vehicle, hence their margins can expand as long as they can maintain or increase their pricing power. But that comes down to can they maintain their brand equity? So if you look at Tesla, I think that they've got a narrow moat, but again, question, is it sustainable? Now, if I were to invest in Tesla for the long run, again, for the next 5 to 10 years, one of my concerns is that they are losing market share in the EV market. So for example, they used to have 79% market share. Now it's down to 68% market share. And this year it's down to 65% market share. So as the years go by, they are losing market share. Now, some of you may say, but Adam, it doesn't matter that they're losing market share because the whole market is increasing, right? So for example, you can see in the next slide that electric vehicles only accounted for 1.8% of all auto sales in 2020, and 2021 it went up to 3.1%, and this year it's up to 5.6%. So if the whole pie is growing, it doesn't matter that they're losing market share, because their sales will still increase because more people are registering EVs, which is true. But the problem is that when you have got more and more competition, what happens? You will face pricing pressure, and the company will then be forced to cut its prices in order to compete in the market. And already that is happening. If you've been reading the news, you know that Tesla, let me just go to this slide right here, they just cut prices in China in order to fend off competition, and they just cut prices for their EVs in the US, and they may be cutting prices in Australia. So to me, this is very, very concerning, because when a company starts to cut prices, that shows that they are losing their pricing power, and that shows that competition is intensifying. So that is one of the concerns I have if I were to invest in Tesla, that they are losing market share, causing more competition, causing pricing power, and this will eventually lead to lower margins, which was my concern in the first place, that again, auto industry will eventually have low margins in the long run. Okay. Now, for the first couple of years, again, Tesla was the only dog in the dog show, in the EV dog show. But as more and more of the legacy companies come into the market and they are replacing their cars with EV cars, you're going to have a whole lot of competition coming in, right? And if you take a look at all the cars in the US, Tesla only has a 3.4% market share of all the cars, right? Toyota has 13% market share, Ford 12% market share, Chevrolet 10% market share. You got Honda, you got Jeep, you got Hyundai, you got it's like a freaking gangbang, right? It's like a freaking mass orgy. You've got all these competitors. So what I'm saying is that yes, Tesla in the earlier years was the only dog, but now there's so many dogs coming in, and 5 to 10 years from now, will this pressure down their margins? That's the concern, all right? Now, the other concern which I have when I was doing some research is this. Now, who do you think are Tesla's main customers? Republicans or Democrats? Conservatives or liberals? The answer, liberals, because liberals are all into the climate change, save the planet, vegetarian, liberal people, right? They tend to buy Tesla more than conservatives. So a recent Pew research showed that Democrats are 2.5 times more likely than Republicans to consider purchasing an EV. Consider, for example, that Democratic California had more than a third of all new EV registrations, whereas Texas, which is more conservative, only had 6.4% of EV registrations, and Florida, which is very conservative as well, 7.4% of registrations. So in other words, Tesla's main market are the Democrats, are the liberals versus the Republicans. But here's the problem. Recently, Elon Musk has become very political, and he has made a lot of political statements that have been pissing off the liberals, pissing off the Democrats. He's been kind of like, promoting some, right-wing extremist conspiracy theories once in a while. He wanted to letting Donald Trump back onto Twitter, and criticizing Anthony Fauci's handling of the COVID crisis, which are alienating his main target base, which are the Democrats, right? So more and more you're seeing people coming out and saying that, I used to be proud to own a Tesla, but I don't want a Tesla anymore because now it's being associated by Elon Musk, who's now getting very, very political, leaning right. So again, all this is causing a change in the brand equity of the company that is concerning. All right, so Elon Musk's Twitter politics add to pressure on Tesla's brand image. And for the first time that they started tracking Tesla's Brand reputation, you can see that since 2016, more respondents in the US reported a negative perception of Tesla than a positive view. This brand perception has eroded further since November 7th. So this is very, very concerning, because a big part of Tesla's magic is the brand, is the reputation. And if he's kind of like killing it because of his behavior, that could be concerning. So these are the things that he's done. He has, banned several prominent journalists from Twitter, and he's been criticizing Fauci and stuff like that, right? So I'm not saying that I agree or I don't agree. I'm just saying that it is affecting his core target market, okay? Now, the other thing that's of course concerning is that, when you invest in a company, the most important thing is that you want the management to be open and honest. You want them to act in the best interest of shareholders and basically to tell you the truth, right? But the problem with Elon recently is he's been saying things and doing something else, which is concerning as a shareholder, okay? So for example, in April of this year, he said, I don't plan to sell any more Tesla shares. And what he just did, on 12 to 14 December, he sold another 22 million shares at $165 to $170, right? Now, of course, maybe he was forced to because of the Twitter deal. Now he's to sell Tesla shares in order to finance the Twitter deal, so he may not have a choice. But the point is that all this is eroding people's perception of this Tony Stark. And like I said, it's a double-edged sword. If the whole company's brand is based on the reputation of one guy, and this guy starts to lose the confidence of his people, that could be really, really concerning. The next step is to calculate what the whole business is worth and what one share is worth, to calculate the intrinsic value. So again, as an investor, you only want to buy a business when you can buy it at less than what it is worth, giving you a margin of safety. And the more unpredictable the business is, the larger the margin of safety that you want. So I'm going to just run through this very, very quickly. If you look at Tesla, you can see that I'm using a discounted free cash flow analysis. Based on the last 12 months, it generated $9 billion in free cash flow. It's got $2.4 billion in debt. It's got $21 billion in cash. So again, financially very, very strong. Now, question is, what's the future growth rate of the business? Okay. Again, it's quite uncertain, but based on Capital IQ, their long-term growth rate, median growth rate is 27.5% growth for the next 5 years. So I'm going to use that number, 27.5% growth for the next 5 years, and then it's going to taper to 15% growth from year 6 to year 10, and finally 4% growth in year 11 to year 20. 3.15 billion shares outstanding. I'm using an 8.4% discount rate. So that gives me a final intrinsic value of, drumroll please, $138.71. So that's the intrinsic value of the shares. So you can see that after falling, it's no longer overpriced. It's no longer overvalued. It seems that it's now, in fact, slightly undervalued. So what's the share price right now? Let's take a look. Current share price of Tesla is $137.57. So based on that share price, it is, well, selling at a 0.8% discount. So basically, it is fairly priced. So in other words, right now, the share price is not expensive, it's not cheap, it is fairly priced. So if I were to buy Tesla, would I buy it at this price? I won't. Why? Because again, I only want to buy it if I get a discount to the intrinsic value. And because you can see that Tesla, I mean, in my opinion, is not that predictable. There are a lot of uncertainties with the market share, the margins and all that. I want a bigger margin of safety. So to me, I'll only be interested to look at it, to buy, if I get at least like a 20% discount to the intrinsic value, right? 20% discount. So if you take 20% discount of 138.71, that'll be like $110. So maybe if it goes below $110, maybe I may buy a bit, all right? But right now, I think that there's not enough discount to be safe enough for an investment. Okay. So let's take a look at the charts and let's identify certain levels of support where one could look to trade or invest in Tesla. Okay, so first of all, when I look at a stock, I always like to take a look at the long-term charts. That's what I look at first, the monthly candles. And you can see on the monthly candles, Tesla has had a strong support at the 50 moving average on the monthly candles. Can you see? Very strong support at the 50. So that was a support that was here. Let me just draw that support here. Boom, right? So you can see it broke that support that was being held up for quite a while, you know. The next support you can see is this orange line, which is the 100 moving average. So I'm going to draw another line at the 100, which is here. Boom. Oops, hold on. Boom, there we are. At about $88. So $88 would be the next very strong support level at $88. Okay, so that could be a potential buy at a very strong support at $88. Now, is there another support in the middle of these two support levels? If we go on to the weekly candles, you can see that this was a previous resistance, swing high and swing low that became a support level. So we could draw another level of support right there. Right? You can see this was a previous swing high, previous swing low that became a support level. So if an investor were to add shares, if it hits this level of support at 117, that would give you roughly about a 16% discount to valuation, which is reasonable, right? But then, like I said, if you're waiting for a 20% discount to valuation, which is safer, then you're looking to add at maybe about 110, which would be somewhere about there, about $110. They'll give you a 20% discount. And if you can add it at $88, $88 divided by 138, that would be roughly about a 37% discount, which would be a pretty good deal if it's a company you want to add into your portfolio. So this has been an analysis into Tesla. Hope it's been useful. If you've got questions or comments, do leave them in the comment section below, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.